kick our next panel here on bridging TradFi and DeFi. So if you want to pop out and keep chatting or take a seat, that would be fantastic. And so again, I'm going to give each of the panelists a chance to introduce themselves. But again, I'm Gerald Gallagher. In real life, I'm general counsel at Say Labs and one of the hosts of the Crypto in America podcast, and one of the stewards of DC DAO. So I will start off as kind of an open-ended question and would love for you guys to, like I said, just introduce yourselves as we get started here. I said in the welcome that I do feel like this is the year that the suits are here. We've been talking about it for a while. But you know, it does seem like every single day traditional finance is integrating more and more with the industry. So the first question is, the industry has talked about institutional adoption for several years. Are we finally seeing that integration, or are we still in early innings? And maybe Miller, I'll kick it off to you to introduce yourself and opine on that.
Sure. Uh-oh. You got the button. I think now I've got it. Gerald, my not so a non-Twitter handle is DeFi suit. So I agree, the suits have arrived. My name is Miller Whitehouse Levine. I've been working on crypto policy for about 8 years now, I hate to say. It's been a long journey here in Washington, but I do think we are in the first inning of TradFi's integration into crypto. I think what is different about this cycle, and I say this cycle because I think over the course of the last decade, there have been every couple of years some attempts by TradFi to get into crypto in some way. And I include things like Libra in that, or JP Morgan had a chain at one point. There's been a lot of experimentation, but I think the thing that has changed this round is the regulatory environment is obviously a much more welcoming to experimentation and innovation. Why I think we're still in the first inning, though, is because I think TradFi is well behind the crypto industry in figuring out what does integrating into DeFi, what does using crypto mean for them in practice and for their business. And I think that is kind of the stage we're in. I think it's quite early, and how it plays out, it's too soon to tell. But I think the kind of divergent paths we're seeing is whether financial institutions and TradFi are going to be willing to, or find it useful to, embrace public infrastructure like public blockchains versus more private walled garden approaches, which historically has been their approach. So I think it's a bit too soon to tell how it's going to play out, but on the policy side, on the business side, I think you know, the integration is occurring, and we'll see what happens.
Hey everybody, my name is Chris. I'm a partner at Fenwick, and I completely agree. I think the suits are here, and I think that there is also an agreement, mass confusion among the suits. What I've observed recently in the market is, I mean, there's a tremendous amount of excitement, and that's phenomenal. But one thing that I'm going to talk about here on this panel today is, I think there's, like, for example, just pick one particular asset class, like private company stock. There is just so many different divergent ways of representing this on chain and getting institutional capital involved, or getting exposure to retail traders or the broader DeFi marketplace, that it's just like, it's almost as if like everybody's put on a suit and you don't know whether that guy was like previously a punk rock drummer or a banker. And like that's just kind of the nature of the industry right now. But we're loving it, and we love all the experimentation. I think it's gonna stick. Some of these models, particularly, you know, huge kudos to both Solana and BitGo for championing and really investing in infrastructure that actual institutions needed before they could make these big, important moves. That's why I think it's going to stick. I think that there are a lot of different approaches out there, but some of them are as good and, frankly, a lot better than the old school way of doing things. And that's powered, you know, by licensed, regulated custodians and people that are willing to put their balance sheet and their policy groups to work to dog food these products. So huge kudos to both of these guys. Great clients, by the way.
Hi, everyone. I'm Steph McCarroll. I'm Associate General Counsel at BitGo, and thanks so much for the nice words, Chris. We are a digital asset infrastructure provider in business since 2013. And I agree with everything you guys said. I would add that it's a spectrum as well, like where in the stack we're fully integrated versus where we're still, in the beginning stage. For example, if we talk about infrastructure like BitGo, we pioneer multi-sig wallets and provide now qualified custody with our OCC charter. That's fully integrated with traditional finance. The institutions are coming. We have over 5,000 institutional clients. These are traditional financial companies that are with us. But then when we talk about DeFi and the liability that DeFi protocols may carry, compliance issues, all of those points are still in early stages, so I wouldn't say they're integrated, but it is an exciting time, so I'm happy to be part of this conversation. Thanks for having me.
Yeah, thank you for coming. And so, Steph, I want to stick with you for a minute. You guys have been obviously a custodian in the space for a long time. We work with you at SAY, and so it's a big happy family here. But you've done two of the most traditional finance things that I can think of, which are one, getting the OCC charter, and then obviously IPOing. As a company with your roots in crypto, what was that process like of just having to meet these bars of compliance or disclosure that maybe weren't present in sort of the previous environments you guys were working in?
Yes, so as you said, we are one of the pioneers in the industry. And from the beginning, even before there was any regulation, we knew we had to be careful, and we knew there were enforcement actions going on by the SEC. So we've always tried to build a product that's safe, and regardless of what the regulation said, and that's why we started our call custody with multi-sig wallets, holding assets. We created a new system of settlement within our infrastructure that is safe, is still in cold custody, but provides faster settlement amongst our clients. And the process wasn't as painful, I wouldn't say, because we started from that view that we had to provide a safe product to attract institutional users who are our main clients right now. And finally, we got to a full circle with our OCC charter. We had a South Dakota trust charter before, regulated by the South Dakota Banking Office, and now we are regulated by the OCC, which again provides credibility that a crypto native company like BitGo can be at par with institutional banks, traditional banks, in providing safe custody for clients.
Yeah, that makes a lot of sense. And so, Chris, for you guys, you have clients that I would say like span the spectrum of
very charitable of you.
Yeah, of maybe more on the degen side versus maybe also seeing some of these pathways to working with larger institutional clients. Like, what has it been like for you guys in the last couple of years to see this shift, maybe from talking a lot more about token launches and utility and governance and that kind of thing to actually working with the suits? We'll keep calling them that.
Yeah. Well, I love my suited friends as well. I wore one today just for them. I think it's actually been a breath of fresh air because, like, much as we loved the excitement and the froth of all of those earlier token launches, just so many of them completely failed to acknowledge and recognize lessons that were already well encapsulated in the regulations and practices of an existing financial services industry. Not to say that we needed to bring the entire thing over, but now that there's like a healthier mixing of perspectives, I find that folks are a lot more willing to slow down, consider, for example, the rights of token holders, which was just an anathema before. And so I think that's been a huge improvement. And I think it's just going to lead to vastly improved quality of assets. I mean, the thing that has really dogged us as an industry, if I could rant and rail just for a moment on a soapbox about Gary Gensler's SEC, we ended up with products and tokens that were just shittier. They were just worse assets. And now the assets, I predict, will be better. I mean, I think, look, there's going to be a lot of crazy shit happening. There's a lot of grift. That's bad. But at least some of the assets which will emerge now in a clear regulatory framework, I think it's they're quite clearly going to be better, higher quality assets that are not going to rug as many people, and that should hopefully carry us through.
And so Miller, working in policy for years and being with Solana now, who's one of the ones who I think pretty confidently say did not rug, being in that space where you guys have done so much, whether it was the tokenization of assets or through the ecosystem doing interesting things in payments. The last panel talked a little bit about, touched on clarity, specifically through the stablecoin yield argument, but we have Genius, a settled law. Clarity is on the horizon at some point. Do you think that institutions need clarity to pass to work with some of these chains, or where do you see kind of the traditional financial institutions looking for clear regulation or just like aping in and trying to figure it out?
Yeah, I think it's an excellent question. I think it largely depends on the financial institution you're talking about or the TradFi player you're talking about. I think the folks that are never going to be able to dive in without legislative clarity are numerous and are primarily led by the banks. In crypto, it's if you have a legal question, there's generally no answer, and all of us are comfortable with that. And it's there's never been an answer. For the banks, that's not an acceptable risk. Like, they have to have it in black and white that it's okay to do something before they do something. So I think for highly regulated financial institutions to really dive in and be competitive, legislation has to pass, and without it, they're going to be on the sidelines still.
Yeah, and so Chris, on the client side, when we're talking about getting comfortable, you talked about slowing down, and that's like a huge thing that I deal with in day-to-day life, where it's like if you're talking about going out and getting licensed architecture, and we'll talk to Steph a bit about her experience, but how comfortable do you think some of these projects are that you're advising with this idea that, like, traditionally it's like get your token out there, get the TVL locked up, get the market making relationships in place, and then just kind of like see how it goes, versus, hey, maybe there is an advantage to us being regulated in this kind of like brave new world? How do you guys deal with that?
Yeah, great question. I mean, for me, it's interesting to watch how each type of client reacts to the same problem set, right? So your sort of more like crypto native degen client is going to think, well, let's just fine, like let's make this token, this product, this platform appealing and workable from the standpoint of the institutions that we're counterparties with, but let's just flex on the token holder side. That the token holders, like, they're used to just buying shit coins and meme coins, so like any notch above that is pretty good. On the TradFi side, those clients, when they're talking to us, they're like, how do I get these massive counterparties comfortable with using my platform, with using my product, with buying my asset, and they actually take a very different approach where they're like, we just need this to look as familiar to these guys as possible. Cayman rated feeder fund, perfect. We'll just stick everything inside of that, and then again on the token holder side, we'll do whatever is needed to be done in order to sort of access this broader crypto market. I think eventually a global network of regulations that somebody smarter than me in like a policy type role needs to think through, like maybe there's I don't know, I'm making this up right now on the spot, don't quote me on this, but like some sort of self-regulatory organization or something like that is going to try to maybe protect the market participants. But right now, what I see are folks just rotating around, making sure that their counterparties who are a little more regulated and are a little more used to engaging counsel are familiar enough with the product and will engage with it.
Yeah, I think just the whole industry needs to be self-certifying. Is that what I heard? Yeah,
that's what I meant.
Not legal advice. So, Steph, on your side of things, Chris just mentioned something like the Cayman Master Feeder Fund, which is a well-established, maybe not as familiar to like retail investors, but a well-established sort of institutional vehicle. And you guys, I'm sure, are custodying institutional assets and some of these maybe like on-chain credit vehicles or some of these other sort of lending vehicles, that kind of a platform. When you saw institutions coming to you wanting to work with you guys, what were some of the key criteria they were looking for and able to get comfortable, right? Because we have a lot of, I would say, maybe a rush into the OCC space and the ability to custody assets responsibly, but maybe not as much of a familiarity on the crypto side with some of these products. Like, what is the Apollo ACRED fund to like the average sort of retail investor, right? So from you guys' perspective, what were some of the vehicles or some of the challenges you were seeing bringing some of those institutions into kind of your world at BitGo?
Yes, thanks for the questions. Starting with the basics, traditional financial companies, they first want security, right? They're going to move massive amounts of value on-chain, and so they want to make sure that they can access qualified custody that is secure. And in addition to that, they explore other types of uses to benefit from blockchains. I think the best analogy I can, and it's not an analogy anymore, but it's an example of how traditional finance came to blockchains through stable coins, through the passage of Genius Act. And as of right now, BitGo issues a stable coin even before Genius was passed through, into law. And we hold almost 5 billion in USD1, for example. So like Chris was saying, institutions they want to feel comfortable with something they know they can compare to, and stablecoins is a great example. If you move settlement on-chain with stablecoins faster, cheapest, then you make these institutions comfortable to come and trade and move assets across borders in an efficient way. So I don't know if I answered your question.
Yeah,
but
no, it makes sense. I'm curious, so but you brought up something interesting that I think we've been thinking about a lot recently, which is the idea of instant settlement for payments makes a lot of sense, right? It's your money is here and then it's there, you're good. The reversibility of transactions maybe is like a separate topic for a separate panel. But just in terms of broad sort of movement of crypto assets as far as it applies to markets and like liquidity, I know we're all sort of lawyers and like policy people up here, but I'm curious whether or not you guys see like instant settlement of on-chain assets as like a feature or a bug. And Miller, maybe you can just kick it off.
Sure. Yeah. I mean, I'll start as it's a feature. I'm a crypto guy, so I want everything happening on chain and self-custody over a public blockchain. That's that's the Kool-Aid I've drank. So it's I'm an instant settlement guy for sure.
I completely agree. And to the earlier comments that we were having about, like, I think what is ultimately going to win here, the highest quality assets, the highest quality products are going to be those that get us towards instant settlement, which is what all of us deserve, given the state of actual technology now. And the bridge, I think, is going to be, and maybe ultimately, like, the actual like enabler of all of this is going to be people that have invested in the licenses and in the regulatory infrastructure to, for example, I'll just pick one real world example. In private company stock, or frankly public company stock, you've got kind of like basically two different approaches in sort of how the market is dealing with this. You've got your effectively like derivatives, so it's like a derivative on private company stock, so it's like a forward or like a loan instrument, and then there's the like a right on the actual issuer of the private company stock itself. You're literally on the cap table. In either of those situations, in order to do this safely and in a high quality manner, you're going to need proper infrastructure. As to which one is going to win out, I cannot make a prediction right now, except that just intuitively, maybe it's because I'm a lawyer, it makes more sense that the token represents the actual thing and not simply a derivative on the thing. I can understand why everybody's very excited about these derivative style products right now, because the distribution is fast and it's a very fungible, it's a very marketable product. But I think in the long run, it's got to be instant settlement and it's got to be straight to the metal. It's got to be at the issuer, and maybe BitGo can help.
Yeah, if I can add something, thanks for bringing that up, Chris. But recently, BitGo signed a partnership, and this is public, with SoFi to issue SoFi USD, which is their stable coin. And this is the first stable coin issued by an FDIC insured bank because the issuers are SoFi. And exactly what you're saying, Chris, like they want to be able to perform instant settlement. And what's interesting about this specific token and stablecoin is because it's FDIC insured, the token holder actually has a right on the deposit. So it's basically a tokenized deposit with SoFi. So it's the actual thing because under the Genius Act, for example, it works a little different. We, as BitGo, we issue USD1, but we're not FDIC insured bank. We're an OCC trust charter, and the holder doesn't have a direct right on the reserves that we hold. They just have a right to redeem the USD1 for the value of the USD1. So it's a nuanced difference, but I think it's something that will attract to retail specifically. And that's what scares a lot of TradFi companies, like, oh, retail is now going to move their deposits on chain, and it's a hot topic right now.
Yeah, no, I want to get into tokenization. I think Chair Atkins and even Chair Seelig have said a lot of really important things for the industry's momentum in that space, but I want to get back to policy just because we are hung up here. I think I remember hearing that we were going to get a vote in, I think before the end of the year was the optimistic timeline, and now here we are in mid-March. Miller, just on this point, because the FDIC insurance thing comes up a lot, and then this idea of collateral on chain and what does that mean for redemption, all that kind of stuff. It's a very complex argument, but I feel like we've been on the Hill long enough talking about this that we should kind of be there on education. So what do you think the Hill is maybe still misunderstanding about the space, or why are we still so hung up on these issues that we all thought were sort of in the rear view?
Sure, I'll say a couple things. The suits have arrived. To your first question, really before 2025, TradFi was totally uninterested in what we were working on in crypto policy. Like, we would go talk to banks and be like, hey, do you guys have, no, we don't care, get these crypto people out of here. Like, same with a bunch of securities players. And so until 2025 on the Hill, there was, it was just an educational game, which is still a huge gap, which I'll come back to. But I think, as far as my work on the Hill is concerned, the big change in 2025 was the arrival of TradFi, so to speak. And, for the banks, they didn't arrive, per se, by, midsummer last year, because the Genius Act passed with this yield language in it. And, as far as they were concerned, they didn't know the Senate Banking Committee had passed a bill. Like, Genius Act 2 is kind of where the banks are right now. So even though that was adjudicated mid-last summer, they, missed it, so to speak, and therefore we're dealing with that now. Same with some of the securities and CEA issues. So, for example, many of the issues that have been litigated last summer in the House had to be relitigated over fall and Christmas because, for example, the Securities Association, SIFMA, missed that provision in the Clarity Act last summer. So
whoops.
It's like I leave it to the bankers and SIFMA panel to tell you why that happened. But we are here where we are. Those voices matter on the Hill, whether we like it or not. So we're having to re-adjudicate it. Then, the education side will always be a problem. Like, there is extreme churn in the House and Senate, especially at the staffer level. Staff are extremely important for getting legislation written, and there's just not enough. There will never be enough, but there certainly are not enough staffers that are super deep into it. Like, thank the Lord for the ones we have, because there would be no legislative text if we didn't have the folks that we have up there right now. But I think they could use more help. The third thing I'll say is, unlike the House, this is the Senate's first real attempt at passing a market structure bill over the Senate floor. Like, Fit 21, Clarity, the House has a few reps under their belt. The Senate does not. And I think that is why the Senate process has looked a bit different than the House process last year.
Yeah, and so Chris, in terms of a practical sense, I've talked before about like there's basically 3 ways that you get an answer on regulatory clarity, on behalf of your clients, right? One is you can litigate it, and your client wins or loses, and you kind of have an answer there. The second is you get legislation passed, and so you have clear rules of the road, and then like weird stuff happens, and you can look at the borderlines, things like that. And then the other is just obviously going to the agencies themselves and looking for exemptive relief or for some kind of sort of active conversation, which, to your point, from the Gensler area, I think was non-existent. But now we can actually have those conversations on behalf of your clients. When you're talking to clients about doing something on the more adventurous side of the spectrum, but that they, sort of in the absence of clarity and legislation, how do you have those conversations? Like, who do you go talk to?
Yeah, this is such a huge new development that I think it even caught me by surprise. This third door that you mentioned, I had no idea the impact that it would have on our clients and how we might be able to operate in this industry, because I think I had just sort of blocked it out as a possibility that you might actually be able to seek a no action letter and talk to staffers about that. Many of our clients are pursuing that now, and it's very exciting because things that really should have been clearly no action letterable are now back on the table. We can't redo so many things, unfortunately. So many entrepreneurs, so many builders, totally wasted, bad law, all that shit happened. But we can now get no action letters. Obviously, the DPIN one is exciting, and there's a bunch of great stuff that we're pushing forward right now. So that's actually the one that I most frequently will advance to clients is like, hey, did you know? This is a thing that we can do, and there's like an active dialogue, which is great.
No, it's nice to be talked to like a human, just another human that's a regulator and wants to know what you're doing. Steph, you guys went, obviously, you were confident enough in your business model to go file an S1 and say, look, this is what we're doing. Do you think there will be more folks who pursue that path, or do you guys view it as a competitive advantage that you went that route? Like, what were those conversations like for you guys?
Yeah, so if some of in the audience doesn't know, we became a public company in January, so very recently. Thank you. And yes, we were confident, and we wanted to bring more credibility to the industry, which I think was a result of that. I can't talk about other crypto companies and what their plans are, if they will follow the same path, but it definitely brought credibility for institutional finance companies in TradFi. We, of course, had many institutional clients, but we do notice that there's more preference, I would say, because, of course, we're in the public eye now. We're going to have our earnings report soon, and everything's transparent, and definitely helps the crypto industry as a whole to give credibility.
Yeah, I'll just jump in on that and acknowledge that the few crypto companies that have gone forward and gone public or have undertaken, for example, the OCC process that you mentioned earlier, they're really paving the way for much, much, much cheaper and faster reps with the same regulators in the future. And so I think that's been a huge feature of this market cycle as well, is the amount of public markets and regulator innovation just from a licensing and IPOing standpoint. I think we're going to see a lot more of that, and we should, and big commendment to those that are admittedly probably paying more in legal fees and dealing with longer wait times than they really should be because of just their market timing, which is unfortunate.
Anyone from Grayscale here, speaking of?
So yeah, I want to get back to the tokenization element of this, right? So it's TradFi and DeFi, right? So we got to talk about it. Chris, you mentioned tokenization. Steph, you mentioned some of the products that you're working with on BitGo, whether it's a stable or something else. Miller, obviously, I think the Solana Foundation did the Mirror token, or Solana. The Mirror token was launched through Republic on Solana, and so that was the tokenized SpaceX stocks that had to do with some of these like more interesting kind of redemption rights. We've seen Galaxy gone public, like purely on chain, which is very interesting. You still have traditional companies issuing their own sort of regular kind of public stock. We saw an enormous spike when the conflict in Iran started of oil futures trading on hyperliquid. And so it does seem like 24/7 tokenization of commodities is like basically an obvious product market fit, maybe outside of stable coins, just as far as like the market picking this up and there being real traction and volume. What do you guys think are some of the most interesting products that could be tokenized, or some of the more exciting things that you are seeing like institutions engage with as like, oh, we get this is lending, or this is, you know, futures, this is spot. Like, where do you think we're going on the tokenization front?
I think, to me, what is most exciting is not the existing products that like exist out there today on the capital raising side. So, limiting my comments to securities, sure, today in the U.S. you can issue a security on chain of several varieties and kind of model agnostic. Right now, you can't trade them in the secondary markets on chain within the U.S. regulatory perimeter. That's going to change in very short order, and I think what is most exciting to me about that is, to the extent, you know, the thesis is right that the disintermediation, to the extent possible, of capital raising and secondary securities markets in the United States will reduce costs for businesses on the one hand and for consumers on the other. What I'm most excited about is what new products or what new businesses will be able to raise money that have never had access to public capital markets that'll be able to do so. So I think that, you know, today it's like $5 million or something to raise money on via a public IPO, which is just like prohibitively cost expensive, obviously, if you're raising anything south of $50 million. I think that you know, the vast majority of the economy are businesses that make less than $50 million in revenue a year, and those folks, to the extent you know, they'll have a new conduit for raising public capital on the one hand, and for people to be able to invest in those businesses on the other hand, we have real opportunity for growth that would otherwise not been tapped, and for investment opportunities and wealth creation on the investor side that were not possible before. So my hope is that you know, all of this leads to some new, cool, innovative things that make people's lives better versus just porting over what's already extant on traditional financial rails and making them a bit more efficient, which is cool, but you know, I think is small potatoes compared to the larger vision.
Yeah, I'm just gonna loop my mortgage on Jito. Was that Chris? How about you?
Yeah, I basically have the same answer. I mean, I likewise am observing like a whole menagerie of models of various tokenization strategies out there, and I've already commented on, like, you know, relative advantages or disadvantages of each. I think that, to your point, it's like, if this doesn't expand market access, then what was the point? And it has to, and I think it will. And that's why, by the way, I think it's okay that there is as much experimentation as there is right now, including in respect to like derivative style, you know, instruments, like derivative versions of their TradFi counterparts. I think that's okay, just to allow the market to build up infrastructure and to sort of build out this distribution engine that just wouldn't exist if we weren't able to experiment right now.
I agree with everything that was said. I would add that tokenized assets are a major player in other continents, like, say, Latin America, and talk about, you know, globalization and access to capital. We here in the U.S. are talking about, you know, when and how the DeFi and TradFi are merging. In Latin America, it's almost there, and they do it for necessity. And it's a topic I'm passionate about because I'm from Latin America. If you go to Brazil, Mexico, Argentina, you can see a huge crypto revolution. People want their savings in stable coins. People now can access US capital markets. So it is a huge evolution. I think, as I said before, and Chris said it, we still need to figure out like ownership of a tokenized asset, and once that's unlocked, I think it's going to be a massive change in the financial system.
Yeah, and so I know we only have a couple minutes left, and then I think we have a bit of a break, so I want to get this last question in terms of, we probably have DC DAO historically is probably more on the DeFi side of the community, not a trade association, not historically getting a lot of financial institution folks in. So just for practical kind of advice for maybe the crowd that's here, for sort of our audience, what do you guys think is maybe a big misconception or piece of advice, non-legal advice, that you would give to a permissionless chain or to someone with a DeFi-focused project who wants to work with traditional finance? What do you guys think that they kind of miss about engaging in that long journey?
I'll start. I think the biggest misconception is that anyone outside of your immediate social circle has any clue what you're talking about or what you do. I think that even folks who are pretty deep in traditional financial services are like, oh, DeFi, I've probably heard that term next to crime, and that's it. So I think, yeah, it's starting from square, -10 is the way to approach it. But it's like educational every time.
Yeah, I think it's a similar point on my end. I think my advice to folks who are starting in DeFi and are building into trying to serve TradFi counterparties and build into this new industry, it would be to leverage existing concepts and existing platforms upon which you can easily analogize and show the success of it, so that you can use case studies and actually even dog fooding pilots, MVPs, those kinds of things to kind of help speed adoption. I think investing in those kinds of projects, which Solana has actually been really helpful for their ecosystem in championing, I think that's got to be the way to go.
Yeah, I can add also that partnering with regulated entities, regulated custodians, and doing it in a way that is compliant. For example, we are in constant communication with the OCC now, exploring new products. So that gives a TradFi player comfort. So that would be my advice for these DeFi protocols.
I love that. Thank you so much, everyone. I think we are going to have a break now, but please join me in thanking our panelists for a great session. Thanks.
You all. Thank you.